Well, stocks are lower this morning as investors assess signs of trade war damage once again. Our next guest says names like Starbucks and McDonald's are already showing signs of a weakening U.S. economy when it comes to positioning. He's betting on Europe. Brad Conger is Chief Investment Officer at Hirtle Callaghan Co. Brad, thanks a lot for joining us. What do you make? I've asked this question of another guest so far, but what do you make of this steady pace of announcements we're hearing from big U.S. companies on the damage they expect to their sales and profit performance because of U.S. tariff policy?
So there's two possible culprits. One is there's just uncertainty around what the future will hold. So that is completely understandable. What concerns me more is the actual downgrades based on current trading activity. And so you saw Clorox last night, Kellogg this morning, you had Kraft Heinz and Pepsi and McDonald's last week. And what they're all saying is there's been a slowdown, particularly in the low income cohort of the US consumer. And to me, given the jobs report, which is still robust, that is a very bad sign.
Okay. What is your view on U.S. equity market exposure versus other parts of the world right now? It's a real talking point among people who manage money.
So our view is Europe is a better place based on purely valuations, not because it will escape any downturn in the U.S., but you're starting out at a valuation of about 14 times earnings versus 21 and a half times for the U.S. And normally that discount for corporate quality of corporate governance is about 2.5 points or 3 points. So from 6 points differential between forward earnings multiple for Europe versus the U.S., I think there is a reasonable trade. And so we've been positive on Europe since the middle of last year. It obviously didn't work last year. It's worked great this quarter, but we think it has more room to run.
You also believe, if I'm reading some of your notes correctly, that you believe European governments have more fiscal room and a willingness to use it to stimulate economies, correct?
Yes, and it's striking because the U.S. has been running a budget deficit of between 5% and 6% for the past 4 or 5 years. Europe has been running something like 2.5%, 3%. Our budget deficit is trending down, and their budget deficit, because of the need to spend on defense, is trending up. And I think that'll be supportive of economic activity in the Eurozone.
Okay. Your view on China, you're overweight China as well.
Well, China is, I think, is a little bit different in the sense that the worse the tariff conflict gets with China, the more impetus they have to support their markets through reduced bank lending requirements, through stimulating, adding liquidity to the system and encouraging the purchase of local stocks. So I actually think that China won't economically escape the tariffs, but the willingness of the government of the Communist Party to support the financial markets is an important. So people talk about the Trump put in the U.S. I think the Xi put is much more powerful.
What's your best forecast of where the very severe trade tensions between the two countries are going?
Look, I think it'll be similar to the last round of negotiations, which is very drawn out, ending up with some commitments that both sides make. And to be honest with you, I think it'll be a muddle through scenario, and it's going to take a long time, a lot longer than the market thinks right now.
Okay, in the U.S., you previously have had an overweight position in defensive growth stocks, such as Visa, MasterCard, Baker Hughes, other stocks that you would characterize as defensive growth stocks. That was a overweight position relative to the Mag 7 stocks. What have you done with that position more recently?
So we closed that position, and the reason was we put it on because that group of stocks was trading something like a 10 or 15% discount to the broader market. And normally they can trade at least par or to a premium to the rest of the market based on their defensiveness and resilience to a downturn. In the first quarter, they were up dramatically. We felt like we were paid for the insurance, and those stocks re-rated up to about a market multiple. And so that was enough justification to take the position off. So we're inclined to, be more defensive, but just right now the valuations aren't telling us to be there.
You also believe the U.S. economy is weakening, and warnings from companies like Starbucks, McDonald's, Procter & Gamble are telling us that. So how do you position your U.S. equity market exposure, given the fact that you believe the U.S. economy is encountering a slowdown?
Look, it's very, very difficult because we know we don't want to be in deep cyclicals. So I don't want to have exposure to capital equipment, aerospace, and industrials. I'm also worried about the tech stocks based on the potential for antitrust to come to the fore. We saw, a big wave of antitrust rulings in the past few months, and as I said, the defensives are more fairly priced now. So one area that I think is a potential hiding place is drug manufacturers. So we like the Europeans, Novo Nordisk and Roche, and Novartis in Europe. But I think you could make the same call in the U.S. So Lilly, Pfizer, Merck. I know there's concern that there will be a sectoral tariff imposed on drug components, but the valuations relative to the growth are still good. So very few places to hide, maybe the pharmas.
Brad Conger, thank you a great deal for this. CIO, Chief Investment Officer at Hirtle Callaghan